Ulrik Strandvik is an attorney and tax specialist with more than 20 years' experience in law.
Direct wealth tax, for me, that's not the solution. I don't think that we will impose a specific wealth tax. I think that we do have taxes that are wealth taxes that we just need to leverage more.
With more than 20 years' experience in law, he has a broad legal background in commercial, property, and tax law.
Before you decide, if you are sitting at home now and you're thinking, I want to get out of this country, and you own trusts, properties and trusts, don't do anything until you've sought advice. Because the minute you say, I'm no longer a South African tax resident, you are deemed to have disposed of all your capital assets at the market value of those assets.
Ulrik is passionate about revolutionizing the world's experience of law.
I think the solution here for South Africa is to drive our economy. We have to drive our economy. We have to get ourselves out of this poverty cycle.
Hello and welcome to the Capital Alchemy podcast, episode 2. I'm Tatenda Chikombero, a business development consultant at Capital International Group, and I'm thrilled to be joined by Ulrik Strandvik from GSM Law. He brings over 2 decades of local international taxation expertise to our conversation. Ulrik and I will unpack a range of themes, including worldwide taxation matters, jurisdictional impacts, world tax considerations, and the tax implications arising from Minister Konongwana's recent budget speech. Let's dive into this insightful conversation. A warm welcome to you, Ulrik.
Thank you. Nice to be here, Tatenda.
Perfect. So can we kick off our discussion by explaining the concept of worldwide taxation? Yeah. Could you just elaborate on what this encompasses? Who does it affect and the pros and cons associated with it?
Yeah. Thanks, Tatenda. I think from a South African tax point of view, it's very important to understand the concept of worldwide taxation because we are a worldwide taxation regime, and it came into play in 2001. So before 2001, we were a source-based taxation country, and in 2001, when capital gains tax was introduced, we became worldwide taxation, which means that if you are a South African tax resident, it's very important to emphasize tax resident, you are taxed on your worldwide income. So, for example, if you own a flat in France, for example, and you earn income there and you're a South African tax resident, South Africa has the right to tax that income.
Okay. Interesting. I don't know, maybe we might get a bit technical here, but I think it's crucial that you address the reporting obligations for individuals and businesses operating globally. Yeah. I mean, and to add on to that, the additional significance of double taxation treaties that South Africa are in from a South African standpoint.
Yeah, those are big topics to tender, and it's important to understand global tax and what's happening in the world of global tax, because it's impacting a lot of South Africans, especially in the changing political environment in South Africa, and people leaving in the country, and people coming back as well, which you also hear those stories, which I hope we hear more and more of as we sort our country out.
All right.
But yeah, so it's quite complex, and I think just stepping one step back in terms of the worldwide income that we are taxed on our worldwide income as South Africans. You also have source-based tax in South Africa. So if you are a foreigner and you work here and you earn an income here, that's source-based and you will be taxed on your income here. If you're an investor here from overseas, come here and you own a flat here, the rent will be taxed here in South Africa. So we also have source-based elements. Okay. Obviously, from a worldwide, where South Africans go overseas, work there, make a life there, you have to consider the tax implications. What are my tax implications? Am I a South African tax resident still, or am I a tax resident of that other country? That's where it becomes very, very complex, and that's where you need to seek tax advice. Because at one point you may be a South African tax resident and you go work in the UK and then you become a tax resident there. The question is, where are you tax resident? Who has the taxing rights on your income?
All right.
Those are the issues. And that's where the double tax treaties come into play.
All right.
And I mean, I can go down a rabbit hole here, so just guide me here to tender. But so those are the key considerations. So when you do leave South Africa, whether you're even going for a short time or going for a longer period to kind of seek your fortune somewhere else, please do think about the tax effects and how it affects yourself, you as a South African tax resident.
All right. Yeah. Out of interest, probably this is just a question that is just popped in my mind. In terms of the local landscape as compared to what a person might come across globally, for example, if they relocate to Australia, I mean, there's so much complaints that I hear about the local tax regime or the local tax regime, system in terms of functionality. From your own experiences, how can you compare the South African tax systems to what's out there in the world?
Yeah, so our tax system is quite a developed tax system.
Okay.
We've worked really hard on our systems. E-filing is a really good system. It's one government department that works really well. I wonder why. So we are comparative with other nations, but where we get unstuck are kind of the implementation of the systems, the kind of collection of tax, the kind of barrier to get into education, explaining the systems to people, making it easier to file, make it easier to, and I think that's where the tax system is going. Because if you look at tax systems in Australia and in the UK, it's very, very easy to file, very simple process, making it very user friendly. I think that's where we are going to get to, and the changes that have been implemented by Kisweta have been fantastic, and I think that we're getting to that point where we're going to make compliance easier. It's actually getting the complexity is getting people into the tax system, getting people to register for tax, getting people to pay tax. The systems are there. We just need to get people into the tax net, which is the difficulty, and that's where education comes in, making it simpler, easier to process.
Okay, perfect. Before I actually get into the next point, I wanted to ask you, I came across some not so impressive figures in terms of who is paying tax in South Africa. I mean, is it something to worry about, or I think there's so much better actions that can be taken to address that?
Yeah. So this was raised again at the budget speech, and so increasing compliance, increasing people. The figures are shocking in terms of who pays tax in this country. Obviously, the black market is big, a lot of money that isn't accounted for. So that is a big challenge for us to increase our tax base, and we have to look at incentives. We have to look at encouraging people to register for tax, to see the benefit of it. Obviously, that is the big question, because without casting any judgment, people say that our taxes aren't being spent appropriately, and I think that that's where the problem comes. If we need to have faith in our taxes system, and faith that our taxes are being used effectively. So I think until we can get that right, looking at seeing corruption being combated, seeing corruption being sought out and dealt with, will give the taxpayer more confidence and therefore increase the net. But we have to look at incentives, look at getting people into the tax net, because that is a big problem.
All right, perfect. So moving on to another stage of our discussion, Ulrik. Let's examine the confronting situation surrounding personal tax, South African trust with offshore beneficiaries, offshore trust with South African-based beneficiaries, and global entities with international offices. Can you share with us some of the challenging scenarios that you've come across throughout your years?
Trusts are in the spotlight, and over the years, you can see SARS has consistently mentioned trusts, and that highlighting trusts, and essentially what they're looking at is making sure that trusts are taxed properly, that people do not hide their income or their assets in trusts. And so they want to regulate and understand trusts better. So if you look at, let's look at grey listing as an example. Now, grey listing impacted us. It came in, we got on the grey list because the Financial Action Task Force said our FICA rules and our FICA Know Your Client regulations aren't strong enough. They haven't seen enough action. So as a result, they said, look, you need to beef up your Know Your Client, and one of that aspect is looking at beneficial ownership. Now, beneficial ownership is a hot-blooded body at the end. At the end, you've got an entity, you've got a company, you've got a trust, but there's someone. There's a hot-blooded person, and that's what they call beneficial ownership. And they want to know who is behind this. They want transparency, complete transparency, for various reasons. Is it a politically exposed person? Is it someone that is on our radar for misappropriating funds or corruption, money laundering and those kind of things? That's one reason. Also, is that person hiding behind this trust structure for their personal tax.
Yeah.
So they can start asking the person questions. Are you using this trust as your, what we call your alter ego?
Yeah.
So part of that is the beneficial ownership register. So the Master of the High Court has now required that Master of the High Court manages all the trusts in South Africa, and is the body that registers and regulates trusts. They have said now you need a beneficial ownership register, and they want to detail all the trustees, all the beneficiaries, all the beneficial owners, including the trust administrator. So they want all the information of these people, and you got to submit that when you submit trusts. And if you don't, then you're going to be, breaking the law.
Yeah.
And that's really has increased the burden of compliance for local trusts. If you ever go look at costs of registering for offshore trust, it's expensive.
It's expensive,
And South African trusts are relatively cheap, but now with this increased compliance, it's pushing that up.
The cost up, yeah.
That's kind of the basis of that question about trusts. So now people are looking at trusts and saying, well, is it actually beneficial to own a trust in South Africa? Should I rather look at an offshore trust, or should I just disband my trust? Because now it's becoming more and more complex. And then you have that, but then you have now a beneficiary of that trust living abroad. So now if you're going to now dispose of your assets to liquidate the trust, you're creating capital gains.
Right.
And those capital gains tax get distributed through what we call the conduit principle. And the beneficiary receives that, and then it's taxed at their hands. But if you're a foreign beneficiary, you are taxed in the hands of the trust. Where instead of the marginal rate of 18%, or the effective rate of 18% in the local beneficiary, it's 36%.
Wow, double the
And double the amount. And now, from the 1st of March 2024, the law has changed, and that includes now income from interest, all other income, interest, rental income will now be taxed at the hands of the trust.
Wow.
So people in closing down trust or re-looking at how they manage their trust need to start looking at, do we have our children left the nest to go and work in another country, now becoming a non-resident beneficiary?
Yeah.
And that impacts, are they actually a non-resident beneficiary? Are they a non-resident in their country, or are they just working there, coming back to South Africa, coming back to our discussion about tax immigration?
Yeah.
So all those factors come into play, and it becomes extremely complex. So the time is coming for people to really take stock of their trusts and say, do we need this trust?
Yeah.
And what are the implications if I close it down?
Yeah.
And now looking at offshore jurisdictions like Australia, like the USA, like the UK, they're quite punitive when it comes to South African trusts or local beneficiaries in that country that have foreign trusts.
Okay.
And you need to understand, how does that jurisdiction deal with my trust in South Africa? And is the income that I receive taxable in that country? And many countries they are. Like Australia, that income is taxable as income. Even though it's capital, it's going to be taxed as income.
All right.
So do your homework. If you own a trust, or not own a trust, if you are a founder of a trust or trustee of a trust and have beneficiaries that are offshore, these are the kind of considerations you have to get into. And it's so important to deal with that.
Whilst we're staying on the topic of South African trusts with offshore beneficiaries, I mean, what are the common hurdles, and what are probably some of the proactive tax-efficient strategies for managing these local trusts with offshore beneficiaries, considering the wide-ranging implications you've just mentioned?
Yeah. I think that's a very good question. I think there are various considerations, and also depends on which jurisdiction you are.
Yeah.
So if you're in a kind of high compliance-driven, rigid tax system like Australia or the US and the UK. It may be a good point to either change beneficiaries if they're foreign beneficiaries, pay them out their share before they become foreign beneficiaries, and then just they get on with their lives, because those jurisdictions deal with trusts differently.
Yeah,
and they can be quite punitive, and onerous. So the income that you earn through a trust, even if it's capital, and being taxed here, they will include as income in that jurisdiction. Right. I'm not a tax specialist in those countries. So if you are in any of those countries, especially Australia, especially USA in trusts, minefield.
Yeah.
You've got to be very, very careful. And the UK now as well. You need to be careful if you are a local beneficiary of a foreign trust in the country. And we can talk about foreign trusts in South Africa later, but very careful, especially if you're in a jurisdiction that is punitive towards trusts. It may be worthwhile to restructure your trust completely, wind down the trust, liquidate, depending on the tax implications, or restructure the beneficiaries.
Okay, interesting. I think building on the discussion of offshore trust with local beneficiaries, something we didn't speak about, but let's actually get into it right now. How do the recent regulatory changes impact the structuring and management of this trust? I mean, not forgetting individuals and businesses with international offices. Moreover to that, what considerations should be prioritizing to ensure compliance and effectiveness in light of these changes?
So I think when it comes to offshore trusts and offshore companies, once again, what's important is the double tax agreements and also the domestic agreements. When it comes to an offshore trust, our regulations have been quite strict, and I'm sure people have heard of the concept of a loop structure, whereby if you invest as a South African into an offshore entity, and whereby it means that the income comes back into South Africa, that's a loop structure, and it has traditionally been illegal and avoided people from setting up foreign trusts. That now has been done away with in theory. So you can apply to the Reserve Bank for a loop structure, and they will approve it depending on the information you give them. So you can then therefore be a beneficiary of an offshore trust, and then that creates a loop structure. Not all offshore trusts create loop structures, but now you can be a beneficiary of a foreign trust where a loop structure is created. When it comes to foreign trusts and South Africans being beneficiaries in foreign trusts, you got to be careful once again on the income that you receive from that trust. It's similar to Australia and USA, but we have provisions that bring a bit of fairness into it. So if you are a local beneficiary of a foreign trust, if the income was deemed to be income in your hands as a South African local, it will be taxed as income in South Africa, and even if it's capital. So you have to then prove to the South African authorities that distribution from the foreign trust is actually has been taxed and it's capital, not income. If you can prove that, then it will be taxed. It won't be taxed here as income.
Perfect. You just mentioned 3 very prominent destinations for South Africans, either to live or work abroad. I mean, not forgetting New Zealand. Can we just talk about the tax considerations with regards to either moving or working with these countries? What are the challenges and strategies that you've mentioned regarding South African trusts with offshore beneficiaries living in these countries? What should they take into account before they actually make the decision either to relocate or either to work in those particular countries, if I may ask?
I think the consideration is bigger than just the trust side of things. It's just your entire kind of tax strategy you need to look at. If you are moving to those jurisdictions, you've got to consider a lot of things. And I think obviously from a trust perspective, you need to look at the impact of being a local beneficiary of that country or a foreign trust. And that's so first thing you do is find a tax consultant in that country. Say, how does it impact me? So that you can, before you even pull the trigger, because once you're there and you now suddenly seen it in their tax net, that horse is bolted. You have to then. So from a strategy point of view, before you decide, if you are sitting at home now and you're thinking, flip, I want to get out of this country, and you own trusts, properties and trusts, don't do anything until you've sought advice firstly from a South African point of view, and secondly in the country that you're going to, where you think you're going to. How do they view trusts? How do they view distributions from that trust? Capital gains from that trust, all those aspects. And then before you pull the trigger, make sure that you either do something with the local trust, extricate yourself as a beneficiary, or close the trust down before. I always say crunch the numbers. What impact does that have? And then from a personal point of view, and this is also a big topic, and that's tax immigration, where we have lots of people wanting to leave the country, and they don't think about the implications from a tax point of view.
Yeah.
So let's say I decide I'm hot for this country, and I want to go to, say, UK.
Yeah.
And then I go live there for years, and I've got a tax number here, and then I go make my home there, and then I start paying tax there, but I still have interest here in South Africa. What is my status?
Yeah.
And that's this whole talk about tax immigration.
Yeah.
And there used to be, foreign exchange was involved in talking about financial immigration, tax immigration. They're all mixed together, and now it's all under the auspices of SARS.
Okay.
So if you want to financially immigrate or tax immigrate, it's all one thing. Dealt with through SARS, and that's very important to know what your obligations are, because the minute you say I'm no longer a South African tax resident, you are deemed to have disposed of all your capital assets at the market value of those assets.
Wow.
And that is what we call an exit tax, Section 9H of the Income Tax Act, and it excludes immovable property, homes here in South Africa. Okay, so don't worry about those, but it shares, properties in offshore, share portfolios offshore, any capital asset that's not immovable property. So let's, for example, say you bought shares in a company worth 1,000 rand.
Yeah.
Many years ago, after 2001. And now you leave South Africa and you tell South Africa, I'm leaving. They'll deem you to have disposed of their capital asset. Yeah. And you haven't actually disposed of it. It's still there. Yeah. But they see your capital asset and they tax it. Then the value says the value is 1 million. Okay. And that the difference is a capital gain. And they will charge you on that. Okay. But you have to now find the cash to pay that, because it's a deemed disposal. You're not disposing of that asset. So those are the kind of considerations. Look, it's complex and you need to get tax advice on this. But before saying I'm no longer a tax resident, think about the implications. And also, I've advised a lot of clients that have been away for many years. Yeah. And they don't know what their tax status is.
Yeah, that's a good point.
My recommendation is just come clean with SARS. Just tax immigrate, pay the tax that's due. If it's complex, seek advice. And then you know that you're no longer a tax resident of South Africa, and that South Africa doesn't have any beef with you.
All right. Great. I think staying in that focus on jurisdictions, this would be an interesting one for our viewers. And listeners. What are the key differences in regulatory frameworks and tax structures among jurisdictions such as like the Isle of Man, Jersey, Guernsey, and Mauritius? I know we've just spoken about the US and Anglo nations, but these are specific destinations that are spoken about, especially in the tax, the tax world.
So this is very interesting, and just to kind of bring into context, is that if you're dealing, say, between South Africa, high tax jurisdiction, and the UK, also high tax jurisdiction, no issues really. You either pay tax in one country or the other country. You might save a bit of tax depending on something, but either tax jurisdiction is not losing out. Well, they may be losing out on a bit, but there are double tax treaties and the like. So you're paying tax there on certain income, and you're paying tax here on certain income. You won't pay tax on both its income, other than obviously the issue of being a non-resident beneficiary of offshore trust, which needs to be addressed. But thinking of other jurisdictions like the Isle of Man, where it's very tax advantageous for companies, for individuals, and then you make a home there. Then it's interesting. Where are you tax resident? Where do you pay tax? And the corporate tax rates in those jurisdictions are very, very favorable. So that's why these tax havens are popular, because people's investments are then taxed at lower rates, and people move their whole kind of head offices there and the like. So they're all popular because they offer lower tax rates. So from a jurisdictional point of view, which one to choose? But you would be interested to know that these jurisdictions have ratings. I'm not a specialist. So some jurisdictions are rated higher than others, and the kind of on certain lists, and they're
Yeah.
scrutinized, and
Yeah.
like the Panama Papers, and
Yeah.
all those things.
Yeah.
And then international tax community it doesn't like things being hidden.
Yeah.
Common reporting standards now, they want to know full disclosure. So if you're going to invest in an offshore structure or in an offshore jurisdiction that gives you good returns or good tax rates, make sure that they're a jurisdiction that is legitimate, that is well known, that has good systems, good compliance, know your client aspects that follow. Obviously, with all the grey listing issues that we had, those jurisdictions are putting South Africans through the ringer. But it's so important to choose a jurisdiction that has got good compliance, like the Isle of Man.
Yeah.
And those Guernsey and those types of jurisdictions, but also cost is expensive. So Mauritius is a good destination as well, and Mauritius is getting their act together with the whole compliance aspect. So it's just a matter of making sure that the jurisdiction is a legitimate jurisdiction and well regulated and the like, and that you are aware of the taxes in that country, and that you are going to be in the spotlight because of the, now you're not paying tax in South Africa, but you're paying tax there,
somewhere
but
else,
you're already paying tax in there. And that also leads me to the issue of Pillar 2. I don't know if you want to talk about
let's go ahead.
Pillar
Let's
2,
go ahead.
which is interesting discussion that it was announced at the budget speech. Pillar 2 is a OECD initiative, global tax aspect, whereby they're looking at multinational enterprises that do work across the globe at a straight tax rate at 15%. So let's, for example, how that would work is, let's say in South Africa, we have the multinationals in South Africa, but their head office, let's say, is in a low tax jurisdiction, and their tax jurisdiction is 10%, for example. And they're claiming tax rights on the profits because that's where they are effectively managed.
Exactly,
in Mauritius. But they do work here. South Africa can't tax that at 27%.
Interesting.
They will tax that if tax that at 10%, or whatever the double tax treaty says. I don't have the details in front of me, but so then you will tax it at the lower rate depending on the double tax treaty. So the global tax community is saying, let's make that 15% across the board. So it stops people from looking for a jurisdiction that is fair. That everyone just pays 15%. If there's a what we call a clash between the two jurisdictions as to who is liable or who's entitled to tax that income.
Right, perfect, interesting. Right, out of interest, how should individuals and businesses evaluate these factors when choosing the right jurisdiction for their international operations or wealth management?
Yeah, that's a big topic as well. So I think the important aspect here, and this is also Pillar 2. Pillar 2, there is a Pillar 1 as well. So Pillar 1 talks about looking at the issue of place of effective management. So if you can show a jurisdiction where you're making profits, that the profits aren't being generated, although the work has been done in the other jurisdiction, all the decision making and
administration,
the strategy is done in the low jurisdiction country through what they call a permanent establishment. Then that low jurisdiction will win the race to tax that income at a lower rate. So the argument has been, well, that can be fictitious. So you say you appoint some directors in that jurisdiction, and they're directors only in name only, and they don't actually make the decisions. They don't actually do the day-to-day running. It's actually done in South Africa by the beneficial owner. He kind of behind the scenes indicates what's going on. So that's also difficult to prove. So the Pillar 1 is looking at taking that issue of permanent establishment and doing away with it.
All right.
Saying that actually look at where your product is being consumed and then tax that
Okay.
in that country. So let's say Amazon's here in South Africa.
Yep.
All the income that is generated from consumption in South Africa is taxed in South Africa. And then obviously looking at pillar 2 together, then you get your kind of 15%, So that's how they're looking. That's where the global tax world is moving towards. It's much more complex than that, but that's just on a kind of high level what they are looking at doing, which I think is quite it's needed because of the digital economy.
I definitely agree with you on that.
You have a company in America selling goods or even e-services here in South Africa, and we consume it here in South Africa, but it's taxed in America. But our taxpayers are the ones that are buying it, and you're making money off our taxpayers.
Exactly.
So therefore, we should be entitled to a share of that. Not everything, just anything that's generated from the source in South Africa or whichever country you are.
Amazing. I agree with you. I think that's a very good development. But just to add on to that, we just mentioned one previously, but I wanted to ask, are there any upcoming trends that might influence the appeal of these locations in terms of either having your wealth managed there or having your operations set up there?
Yeah, so I think from a tax point of view, you just have to get good at tax advice in terms of investing in an offshore structure, investing in an offshore jurisdiction.
Yeah.
There, for me, would be looking at the quality of the platform that you're using, like Capital International. It's well-known, well-regulated. Because you don't want to fall foul of the common reporting standards. So that's the key. So if you're using a jurisdiction where the platforms that are in those jurisdictions are well managed, well regulated, absolutely. And then also obviously looking into the structures themselves. Lots of South Africans are wanting to take their money offshore, rather than to kind of hedge their bets. Dollar dominated. So make sure that you use a platform that understands that, a platform that can help you establish that, like Capital International. I think that's what's important, and I think just do your homework. Understand how the international community looks at that jurisdiction. It's very important. Don't just invest in a jurisdiction that's got good tax cuts or whatever.
But a tainted reputation.
Look at what the international community is saying about that jurisdiction. Do your due diligence before you invest. But South Africans, our exchange control regulations are being relaxed all the time. As South Africans, you can take out 10 million rand a year as individuals with a tax clearance. So we need to show SARS as a tax clearance. And also in that, by the way, funny enough, in that application process, they will ask you about foreign trusts. Do you own? They want to know all your assets offshore. So it's an information gathering exercise. So when you do that, make sure that you are open and honest with the application for your tax clearance for we call it a foreign investment allowance. So as South Africans, you can take 10 million rand out a year with a tax clearance, as long as you're completely open with your assets offshore, or all foreign assets. Are you a trust? Are you a beneficiary of a trust, offshore, local, all those things? And that's the same application they would use if you immigrate, tax immigrate. So then, as South Africans, you are entitled to take 10 million rand offshore. I mean, what a pleasure! Make sure
it's a lot of money.
Yeah, it is. So often people don't realize that. So it's important for you to then, knowing that, linking up with a good platform that can actually help you invest that money properly. Now that 10 million is not only 10 million; it's actually 11 million, because 1 million of that. The
1 million is
it's your discretionary allowance of 1 million, and there you don't need a tax clearance certificate. So many South Africans don't realize that they can do that every year, but in doing so, make sure that you fully disclose it and that you invest it in. Don't do it on an emotional, I need to get my money out of South Africa. And I'm not necessarily a proponent of taking everything out of South Africa. I'm a proponent of, being invested in South Africa, help building South Africa, but also, being careful with your estate and making sure that you have some exposure offshore. That's just my personal opinion. Yeah.
I think personally, not that I have the money to ship outside there, but being part of the global investment community, I think it's very important for anyone around the world. It's so important for also South Africans to be vested with what's going on out there in the jurisdictions we've spoken about. So I think as we segue into the next point, I would like you to debunk the topic of wealth tax in South Africa. I think it's a very sticky one.
Yeah. No, thank you. Yeah, wealth tax is a hot topic and it comes up every budget speech.
Yeah.
And I think that for me, the essence of wealth tax is a bit of it's a red herring. I think that this is my personal opinion. I don't think that we will impose a specific wealth tax.
Okay.
I think that we do have taxes that are wealth taxes.
Interesting.
In South Africa,
Okay.
that we just need to leverage more and collect properly. So let's take a step back. What's the context of wealth tax? Wealth tax is we're in a country that, according to the Gini coefficient, we are of 0.67.
Yeah.
We are the most unequal society
Yeah.
in the world. And we just had a session this morning,
Yeah.
coffee with Capital, and the point was that relative inequality, that relative gap,
Yeah.
is a cesspool for violence. And people, seeing the disparity in wealth, it creates violence and creates crime, and that's very worrying in this country. And I think that a wealth tax won't be the solution there. And I think that firstly we'll see more people tax immigrating. We spoke about that. We'll see more people using their bonds, their financial, their FIA, and we'll see brain drain potentially. It's also complex to create a new tax and facilitate that.
Exactly. Yeah. On top of all the tax,
exactly. And also the difference is that we trying to bridge the gap, but by people taking money offshore, they're just making that wealth bigger. So the gap's just going to grow. And I think that for me, our solution is to look at our current taxes. So if you look at what I would consider our wealth taxes in South Africa, you've got capital gains tax, you've got estate duty, and you've got donations tax. And for me, those are essentially our wealth taxes. And if I had to look at, as an attorney, we do estates, deceased estates, and just there's a lot of low-hanging fruit there for SARS. If they are getting better at auditing estates for estate duty, and collecting more revenue, but it hasn't been that great in terms of collection. And I think they can, make that stronger, collecting tax from estate duty. The big estates out there. Capital gains tax, we 20 plus years in the capital gains tax regime.
Okay.
People are selling their capital assets, and also it might be sporadic because people have to sell their assets to go overseas or tax immigrate. But we'll see more and more, income from a capital gains tax point of view. It's very small, as a drop in the ocean, but that in essence is, for me, what is our wealth taxes. We need to manage those taxes better. Another example would be donations tax and estate duty. Anything over a donation over 30 million is at 25%, and over 30 million estate is at 25%.
Okay.
So that is an indirect wealth tax. So big estates are then forced to decide if their estate's worth let's say 50 million. That do they now donate? To 21 million.
Okay.
And then pay 20% on the donation instead of then waiting to pay 25%. Those kind of considerations. So perhaps we'll see more revenue coming in from a donations tax point of view. But a direct wealth tax for me, I think, is that's not the solution. The solution in South Africa, and I'm getting a bit political here, but I think the solution here in South Africa is to drive our economy. We have to drive our economy. We have to get ourselves out of this poverty cycle, and we need to do everything that in our strength to improve education, improve job security, and getting people into jobs, improving our economy, and that must be our single focus. And then we'll see things align. There are it's so easy to say that right now. It's so complex getting there. But I think that if we can unite as South Africans and just raise, our economy, and that being our single focus, is crucial.
Perfect. Let's actually move on to a very fascinating realm of investment migration. You touched a bit on it.
Yeah.
I think phenomenon that's developing locally on a very, very fast basis of individuals shifting financially rather than physically. And I know golden visas has become a popular avenue in this realm.
Yeah.
What are their implications on taxation?
Yeah, I think the same principles will apply. I think, like a Portuguese golden visa. You go to Malta and you invest a certain amount of money in the country, and then you get a foreign passport.
Okay,
I think that's for people. Another thing people are scared of is that if something goes wrong in South Africa, can I leave? And having a foreign passport helps there. So in doing that, just once again, do your homework. Does that impact your tax status in South Africa? And how does that impact you in that foreign jurisdiction from a tax point of view? So if you now buy your golden visa, does that make you a tax resident of that country? Are you a dual tax resident? I think you can manage your affairs well so that you are a dual resident and that you haven't got a situation where suddenly you're taxed on your worldwide income and including your income, say, from Portugal. Just make sure that whichever jurisdiction you go to, there is a in-place double tax treaty.
Okay.
And that if there is any tiebreakers, you can deal with that. I think that's really, really important, is to do your homework before you even go that route. How does that impact me from a South African tax point of view, and what is my risk in that other jurisdiction? And I think it's good at this point in time to talk a bit about the tiebreaker rules, which is quite interesting. So if you look at South Africa and let's say Portugal, for example, and those South Africa deem you to be a South African tax resident, and Portugal deems you to be a Portuguese tax resident. Just as an example, who has taxing rights? That's the question they want to ask. Does Portugal have taxing rights, or does South Africa have taxing rights on that income? Okay. So the question you have to ask firstly is, where is that person ordinarily resident? Where do they live? Have their being, and go home from school? Those kind of things. Go home from work. Where's your and if it's in both countries, because people do, they have both countries. Then you ask, where's your center of vital interests? Where are your investments? Where's your family? Where's your where's your golf club? Where do you play golf? And if that's also in both countries, could be. And then you ask other questions. I mean, every tiebreaker rule is different in different double tax treaties. But then ultimately they ask, where do you have permanent home? If it's in permanent home in both countries, then it comes down to your nationality. Where are you a national? And then that country ultimately has taxing rights. So that's interesting. So before you go buy that golden visa, or even decide to tax immigrate, those are the kind of questions you need to ask yourself.
Okay, perfect. As we wrap up our discussion, Ulrik, we're within the tax season. I mean, any closing remarks that you'd like to let our listeners know? Pointers, nuggets, etc.
Thanks. I think things to watch going forward would be the pillar 2, the 15% multinational enterprise tax across the globe. That's probably going to come into play. The things out for comment, the documents out for comment. So that's an interesting thing to watch.
Okay.
Just from a obviously tax point of view, we're in for a tough season. I think it's hard for all of us. Everyone's struggling. I think going to the polls, there's going to be a lot of politicking. Exactly. So just look at the trends, and not the headlines. Look at what's happening. Don't get swayed by public opinion. Do your homework, and then just everyone must vote. I think that's what's important. I think this country needs some invigoration and needs some accountability. I mean, the finance minister did say that they're going to put pressure on the SOEs. Look at outputs, look at performance, and let's hope they do that. We are desperate need of delivery in this country. Definite need of people doing their jobs and doing their jobs properly, and getting the right people in the right seats. qualified people doing the jobs. You know, we need to kind of just unite as South Africans, and get around improving our economy, and that's really kind of my thoughts.
Perfect. Amazing. Good one. As we draw to a close, we hope you found this discussion enlightening and informative. Ulrik, thank you for being a guest on our podcast.
Tatenda, absolute pleasure. Thank you to you and the Capital International team for the opportunity. I so enjoyed the discussion, and I hope the listeners and viewers found it interesting.